Hello and welcome to the monthly macro and market update, where we discuss key developments during July 2023. Equities continue to move up for the fourth month in succession. Given how well risks assets have done in first half 2023, and if this combination of disinflation, modest growth and a gentle cooling in labor market persists, many investors are questioning the idea that whether we will see a recession in the US towards the end of 2023. Soft landing seems to be the new accepted wisdom amongst many, including US Fed. China's economic momentum remained sluggish in June due to property sector and exports, but did not worsen substantially further, following a sharp slowdown in April and May. Recent Politburo meetings acknowledged the current property woes and opened the door further for a policy shift from stabilizing to at least modestly stimulating. Unlike the US, money supply growth has risen very sharply in China and could aid some bit of economic recovery, though it remains to be seen how further policy efforts can turn around consumer confidence and property sector. Commodities have had a solid few weeks. Overall, Bloomberg Commodity Index is marginally up 2.5% year to date. Simplest explanation is that the fear of US recession is dissipating, and alongside indicated policy shift in China has led some support to commodities. Also, there are some renewed supply concerns out of Russia and Ukraine. As we enter the second half of 2023, it seems possible that the coming months could deliver decent US growth, more Chinese stimulus, and a weaker US dollar. All of this pointing to a continued momentum in the risk assets. But history suggests that the caution is still warranted. Given that the underlying problems of higher rates and declining manufacturing output globally, tightening credit standards, contracting money supply growth, and depleting excess savings in the US, it is way too soon to sound all clear on the recession front. Real rates have finally turned positive in the US only now. At 2%, it is the highest since global financial crisis. And given where valuations are today, they cannot sustain any earnings downgrade. Even as housing starts have improved in recent months, the affordability in the US has deteriorated. Prices continue to stay tepid. US excess savings are fast depleting, which would prove that the latest rebound in consumer confidence could fade very soon. DXY weakened a bit in July, but is pretty range-bound, so to speak. The end of the Fed's hiking cycle will help to soften the USD, and further signs of inflation ebbing will also matter. But to really see the USD's range-bound behavior finish and renewed weakness emerge, stronger evidence that a softer landing for the global growth, including the US economy, must also materialize. In India, strong FPI inflow has driven a strong BOP surplus, even as the FDI inflow is moderating. Despite favorable turn to external capital inflow, rupee trades in a very tight range of 81.2 to 82.8 against US dollar year to date due to aggressive RBI's intervention. RBI should be okay to purchase foreign currency and expand balance sheet and replenish its FX reserves. This could keep rupee anchored against US dollar in the near term. Even as it is range-bound against dollar, rupee has appreciated very sharply by 11% against Japanese yen and 6% against Chinese renminbi year to date, but depreciated 4% and 1% against GBP and Euro respectively. Q1 FY24 earnings started with a weak outcome and guidance on IT and chemical companies, but continued profit growth and lower provision for banks. FMCG companies point to a modest rural recovery. Till now, earnings outcome resonate activity trends, which is falling goods and services exports, but falling inflation aiding consumer sentiments and demand. State capex has increased substantially from a low base of last 1.5 years. Overall, infrastructure orders are healthy, which keeps cement production growth at 16% and result beat for cement companies. By next month, we will have a full picture on earnings. But challenge today is that valuations have once again run up so much that it cannot afford any earnings downgrade. We stay cautious on Indian equities. Coming to fixed income market, both US and Indian yields remained in a very tight range during the month. The latest Fed policy delivered the expected 25 basis point hike, did not deliver any surprises and stays data dependent. Fed dot plot are aligned for one more hike this year. Headline inflation has cooled off to 3.1% in US. Core PCE is at 4.1%. We expect core US inflation to fall to 3.5%, aided by fall in shelter inflation and easing supply chain concerns. Even as we enter the phase where global bond yields could move down, domestic yields could stay sideways. Tomato woes and erratic weather could lead inflation to rise to 6 to 6.5% in Q2 before settling back to 5% by the end of FY24. Core inflation is on a downward trajectory, averaging just over 5% in last 3 months. We do not pencil any rate cuts by the RBI in FY24. Central government is front-loading tax devolution and capex loan to states. SDL issuances are higher than the same time last year despite the increased devolution by the centre. This is because states' expenditure has picked up. States have budgeted 9.5 trillion of SDL issuances for this year. We think it could largely go through. Corporate bond supply has also jumped in Q1 FY24. There is a reasonable pipeline in terms of bond supply. Higher supply in the corporate bonds and SDL are largely getting absorbed without a significant rise in spreads, perhaps also aided by improved banking system liquidity. FYTD, FX intervention by RBI, almost entirely explains the liquidity rise in the banking system. Liquidity could still come down in second half FY24 despite a positive turn in external account, given that we estimate 2.5 trillion of currency outflow in the second half. This will keep money market rates volatile and could lead to some rise in spreads. Strong dollar inflow dims the prospect of OMO purchase, which was earlier anticipated by the market. In the very near term, we run a slightly cautious stance on duration and would look for an opportune time to build it back. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.